Time for Yahoo Finance's Market Minute. Stocks edging higher as investors try to hold on to that risk-on rally. Disappointing economic data, higher steel and aluminum tariffs, as well as U.S.-China trade tensions putting some pressure on sentiment. CoreWeave shares extending gains today. The stock surging over 20% Tuesday on news of a $7 billion data center deal with Applied Digital. This morning, the company announcing a new chief architect of strategic financing as it looks to drive its next phase of growth. Meantime, CrowdStrike getting a downgrade from Bank of America to neutral from buy. The analysts saying they expect the company's growth to decelerate. This comes off the back of CrowdStrike's disappointing revenue forecast. The cybersecurity firm is spending millions on customer retention efforts following last summer's widespread outage. That is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code below where you can track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, Portfolio Check-In. One expert tells us policy uncertainty will continue to fuel volatility this summer, but how should you position yourself? We're going to discuss that. And the Trump-backed no tax on tips policy has broad support, but there are some financial risks associated with the plans. We'll dig in. Plus, Nvidia has regained the title of most valuable company. We'll discuss how much that title has helped CEO Jensen Huang as well so far this year. All that and much more this hour. But first, let's begin, as we always do, taking a look at some of the market action. 90 minutes into the trading day, we're seeing green across the screen, if you will. Fractional gains for the Dow, the S&P 500, and the NASDAQ as stocks edge higher after a weaker than expected ADP jobs data print, as trade policy uncertainty weighs on the economy and some of those hiring plans. My next guest says that investors shouldn't sweat the volatility this summer and instead just ride it out. Joining me now, we've got Will McGough, Prime Capital Financial Deputy Chief Investment Officer. All right, you say that investors need to stay engaged in risk assets, but with a tactical mindset. So what are the best ways to really do that right now?
Hey, Brad, thanks for having me on. And my recommendation right now is to enjoy the summer. Markets are in a range, both with equities and rates. We have about a 20% S&P range for the year. Tariff policy, administration, Washington, D.C. has caused a lot of that volatility. We're going to see how it affects stocks going forward with earnings and future earnings seasons, but also Washington, D.C. is driving rates and inflation too with the big, beautiful bill, potentially causing some concerns with more deficit spending. So the 10-year is in a range as well from 4% to 5%, and we're about midpoint there. So I think things just stay in the range, and if you want to be active, you can adjust exposures near the top and the bottom of those ranges. But otherwise, there's not really anything that's going to get us excited about that range being broken substantially to the upside or downside. So you might as well enjoy your summer.
I mean, we still have this, of course, expiration of the 90-day kind of truce period on tariffs. We still have 3 Fed meetings that are going to be taking place where we get some type of tone or tenor as to how the Fed is really working through everything from what President Trump is calling J-Pal on any given day all the way through to the real policy and their dual mandate of maximum employment and stabilized prices. So those are not nothing burger events, but how do you expect that markets will try to best anticipate what the outcomes of those events might be, as evidenced through some of the trading that we see take place?
Right. So, I mean, in lieu of all the news that we've seen with steel tariffs and the delay of tariffs, we've got early July coming up for the next round of tariff negotiations. You had the Ukraine and Russia escalation. You got a lot of bad news that's out there, but it's just noise. So equities are still kind of hanging in there near the top end of the range. I think everybody's pretty obviously watching the Fed on pause here. Jackson Hole in August is going to be a big point in time, or they probably won't announce any sort of easing, but they could loosen financial conditions, which would help out too. So we're still kind of in a little QT, quantitative tightening environment. So it's going to be interesting to see what they do with the balance sheet, how they're going to work with Bessent and the Treasury and all the issuance they need to do, and especially how this bill gets through the Senate. and what shape or form is it going to be in now that we have Elon out there trying to talk it down based upon what he saw come out of the House and what's going to the Senate. So it's a fascinating market environment. We usually don't have Washington, D.C. driving the markets like this. Typically, Wall Street loves the dysfunction in Washington, D.C., where you have a balance of power amongst parties. And we obviously kind of don't have that right now. So Washington, D.C. is driving a lot of trickle-down effects through the stock markets and with fundamentals of stocks through trade policy.
You're also looking across, based on your notes, blending U.S. bellwethers and Mag 7 plus a few other key tech picks. Who are those?
Right. So we've been cautioning to our advisors all year to core things up. The growth overweight has worked since global financial crisis in the bull market. Mag 7 has become all the rage, so a lot of folks are concentrated in those 7 stocks. So we like pairing bellwethers, think about diamonds, with broad technology so that you can take advantage of some of these names that are driving AI that haven't made their way up to the Mag 7 yet. You have Palantir, CrowdStrike, even Netflix is doing really well this year. So I think owning a more broad basket of tech outside the Mag 7 paired with bellwethers in a market weight fashion is the way to go here.
Will, thanks so much for taking the time here with us today.
Absolutely. Thanks for having me.
Now time for some of today's trending tickers. We are watching PayPal, Snowflake, and Asana. First up, PayPal-owned Venmo, adding new features in hopes of expanding user adoption of its debit card and other financial services. The updates include 15% cashback for Venmo debit card holders at retailers, including Walmart, McDonald's, and Sephora, as well as expanding its Pay with Venmo feature. Next up, Snowflake getting an upgrade to buy from neutral. UBS is the one behind this call, and along with several price target hikes following its summit, UBS analysts saying that it's not too late to take advantage of what could be just the beginning of a sustained enterprise investment in data services and cloud providers. Evercore ISI, which raised its price target to $240, saying AI has reached a tipping point, and that makes Snowflake's current pace of growth durable. Finally here, we're checking in on shares of Asana, falling on worries about the software company's sales growth, which slowed to 9%. That's down from 26% growth a year ago. Despite narrowly beating the street's expectations for the first quarter, Citi analysts warning, quote, the billings miss and guide down raises some growth concerns. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, we dive deeper into that disappointing private payrolls data with ADP's chief economist. Plus, we explore the potential risks of the Trump-backed no tax on tips policy. All that and much more on the other side of this break. The pace of hiring in May reached its lowest level since March of 2023, according to new data out from ADP. Private employers added just 37,000 jobs during the month, below economists' expectations of 114,000. Here to react to the report, we've got Neela Richardson, who is the ADP chief economist. Great to speak with you once again, Neela. Just take us into your reaction. What took place within this most recent month, and how much of this is tied back to tepidness in hiring stemming from some of the tariff uncertainty right now?
Nice to see you again, Brad. You know, we saw some hiring momentum in the early part of 2025, and that momentum is starting to slow. So when I look at this particular report and what's driving the numbers, the first place to stop is the goods sector. The goods sector overall was weak. Manufacturing that had seen a burst of hiring in February and March shed jobs in May, and that's consistent with the manufacturer surveys that we've seen. They've been downbeat and pointing to contraction after showing some signs of earlier optimism. I'll also point to the construction numbers that are lower than we're used to seeing, and so that is a place of weakness. And then when I turn over to the services side, and we got the new data from ISM on the services index showing a bit of a downbeat outlook for service providers even. You see that for professional business services, those B2B businesses, they lost jobs as well. within all of this, there was some places of strength, and one to highlight is leisure and hospitality. That's a consumer-focused sector. So if the consumers are doing well and they're spending on entertainment, that's a good sign. And I know there's a lot of data here, Brad, but one other important point is that the smallest businesses lost the most jobs. So when you talk about uncertainty and the fog that's kind of on the outlook for now, it's really small businesses that are having the most trouble navigating it in terms of their hiring.
Would love to get your read through on some of the the worker pay, and some of the move that we saw there, because as we're taking a look at the median change in annual pay, it's still paid more to be a job changer than a job stayer. Job stayers seeing a rise of 4.5% versus job changers seeing 7%.
Exactly. Those are robust pay levels. We'll take those all day long. Even as workers, we'll take those all day long to get a bump in pay that is typical of 7% from just changing jobs. Historically is quite robust. And so that tells you two things. One, even though the hiring momentum is slowing, it's not necessarily slowing because of lack of demand. It's slowing maybe because of this hesitancy. And the other thing it tells you is that this is still a relatively tight labor market. This is still a labor market where the workers who are most sensitive to local labor market conditions and real-time conditions, those job switchers, are still seeing outsized pay gains. And so overall, this is a soft spot, 2 months of a soft spot, but in the context of a broader, more resilient labor market.
You know, you raised an interesting point within the small business landscape, and I was just pulling up the NFIB Small Business Optimism Index, which had actually declined during the month of April. So how much of that do you expect to continue to be perhaps a headwind that small businesses are enduring in this near-term period of time, as it might correlate directly through to some of the job openings, the hirings, and as well some of the layoffs that might take place?
Yes, there are several reasons to double click on the small business numbers, including what you noted, which is a slowdown in optimism. It's edging downward. But also, if you think about it, if you look at the quarterly census of employment and wages, and I realize not many people do, but it's almost a near census of every employee in the United States, what you'll see is that about 73% of employment comes from firms with under 250 employees. So small firms are the engine of growth of the labor market. And so to see weakness there is troubling if you're thinking about the outlook and employment in general. And small firms don't have the same options as larger firms. For example, they don't have access in the same way to the capital markets. They're dependent on bank loans. They're not able to navigate in terms of where they're sourcing supply as easily in the short term. They are more vulnerable to input costs. They have thinner margins. And so small firms are really the place to watch if you want to know what the overall economy will be doing in the next few months.
And so if you are the Fed, ingesting and looking through all of this data that's come out over the course of this week, knowing that we're also going to have the monthly jobs report at the end of the week, you had JOLTS that had a surprise to the upside in openings during the month of April. And then additionally, here you had a far lower than expected print in the private sector in terms of 37,000 jobs added versus 100,000 plus jobs that were expected to be added. What do you think the Fed's read through of all this might be?
I think that for a monetary policymaker, you're going to zero in on the wage and pay data in both the ADP data set and the BLS data set, because wages are the bridge between the labor market and inflation. So if you want to know what the inflation outlook is going to be, one key input, it's not the only one, is pay. Also, it's a good indicator on the overall health of the labor market as jobs data ebbs and flows throughout the year. So when I see those pay numbers of 7% for job changers, 4.5% for job stayers, what I see is a labor market that is still resilient, but not triggering inflation. That gives the Fed the latitude to really kind of continue to decipher their own inflation outlook, because the labor market isn't collapsing and worker pay growth is still growing, but not enough to trigger inflation.
Nayla, appreciate the time as always. Thank you so much for taking the time.
Thanks for having me, Brad. Take care.
The Senate is starting to discuss The Trump-backed tax bill passed by the House of Representatives last month. One part of the bill that has broad appeal is a no tax on tips provision. The policy would exempt up to $25,000 in tips from federal income tax for people making less than $160,000 in 2025. But there are some risks that Americans should be aware of. Here to explain, we've got the debt-free guys, David and John Ottenschneider, co-hosts of the Living Not So Fabulously video podcast as well. David, let's start with you. There seems to be some confusion around whether tips below the $25,000 threshold should be reported when filing taxes. Could you break it down for us?
Certainly, Brad. Thanks again for having us back. So there's long been confusion around how much tips really need to be reported. Depending on what industry you're in, some people say a certain percentage, some people say you don't need to report at all. And now we think that some people are starting to float this idea that you don't need to report the first $25,000 of your tips. And that's truly not the case. We don't want folks to look at this as an opportunity to say, I don't need to report the first $25,000 of my cash tips to my employer. And really the reason for that is that your employer with this bill will have the opportunity to basically take a $25,000 deduction from your reported tips that are withheld for federal income taxes only. So federal income taxes on the first $25,000 would not be withheld. And it's important here that you want to report all of your tips, and there's multiple reasons why.
So John, let's talk about the downsides here. This policy does bring some risk to people's future retirement. How so?
Yeah, and to be clear, the downside is only related to underreporting or not reporting your tips at all. So for example, in 2025, you must earn $1,730 to receive one Social Security work credit for a maximum of 4 credits per year. So in 2025, 4 times 1,730 is 6,920. That's the maximum that you can earn per year, even if you earn more than that in a year. To qualify for Social Security, most workers must have 40 work credits, which usually takes most of us about 10 years to meet that threshold, unless you underreport or don't report all your tips. Then it's going to take you a lot longer. Plus, there are other benefits that you can get from Social Security from reporting all of your income, including your tips, that you don't want to miss out on later in life.
Now, David, under this policy, there is some risk to your money if you lose your job. Why is that?
Right. Again, the risks here are when it comes to when you lose your job is related to underreporting or not reporting your tips, especially if you think you don't have to report that first $25,000. If you don't fully report your tips, you can miss out on accruing unemployment benefits. Unemployment benefits are really based on your reported income. Depending on the state, they look back anywhere from about 4 to 5 quarters to see what you've been reporting for income, and that's how they calculate that. So the lower your reported income, the less you're going to receive in unemployment benefits, which is something that a lot of folks really realized that happened to them during the pandemic. All of a sudden, they realized that they weren't getting any unemployment benefits or were getting less because they weren't fully reporting their income. And again, this is dependent on the state level calculation. So you want to make sure you're reporting fully your income so that you get the max benefit if you are laid off or furloughed.
Now, John, under this plan, you may not pay federal taxes on tips, but there are other taxes that you'll still have to account for, right?
Yes, whether or not this becomes law, this is only affecting the federal law. You still are required to pay state, city, local income tax based on whatever you're required to do in your region. In addition, you and your employer are required to pay Social Security and Medicare taxes on all of the tips that you earn. And of course, you're probably going to want to have Medicare sometime down the road. So again, this no tax on tip only affects a total of federal taxes of up to $25,000. You still want to report it, even though you're not going to pay taxes on that first $25K.
John and David, good to see you. Thanks so much for breaking this down for us.
Thanks for having us again.
Coming up, I'll break down the net worth of the man behind the most valuable company by market cap, Nvidia's Jensen Huang. That's next on Wealth. We are just about 2 hours into the trading session here. Let's get a check on the markets for you. Taking a look at the Dow Jones Industrial Average right now, up by about 0.1%, fractional gains there. The Nasdaq Composite, which did slip into negative territory early during the 10 a.m. hour, has moved off of those session lows and is now back in positive territory, holding on to that for the majority of the session here. We're up by about 0.3% right now. And the S&P 500, you're seeing gains there. Again, a little flirtatious with negative territory earlier on, but it has moved higher and up by about 0.2% as of this point in time. Also want to check in on some of the heat maps that we've got loaded up here for you on the screen. These are some of the record highs since the April 8th bottom here. And we pointed out, of course, Broadcom, company that's going to be reporting earnings this week. We're going to be watching closely for that. A company that's also very much intertwined within some of the devices that you use every single day. We're going to be watching to see what they say when they report earnings. Those shares are up by about 1.25%. I also want to take a brief look at some of the sector activity. We've got that loaded up here for you as well. 11 S&P 500 sectors that we love to keep tabs on during the session just to see who's moving, who's shaking, who's lagging. And let's put this on an intraday view. Ultimately, boosting, or at least trying to put the team on its back, healthcare right now. That's up by about 0.7%. However, you still have 5 laggards here. So of the 11 sectors, you're still seeing more gainers than laggards, but energy, that is weighing on things right now. That's down by about 1.2%. Utilities down 0.7% as well. Lastly, let's ride out with a look at the NASDAQ 100, the tech-heavy average here. You're seeing much of the Magnificent Seven, sans Tesla, in positive territory as of right now. Nvidia, fractional gains there. Meta seeing a jump of about 2.25% here on the session. So we'll continue to watch that as we get further into today's trading session. Hey, since I mentioned Nvidia, let's double click there. Nvidia is once again the largest U.S. company by market cap. The AI darling has a market cap of $3.45 trillion, just barely surpassing its fellow Mag 7 member, Microsoft. Investors fled into the stock back in January as part of the AI scare around China's DeepSeek. They fled out of it, and then ultimately a broader tech rout and concerns over China chip curbs have kept the stock below the $140 per share marker since February. But get this, shares closed above that level Tuesday, rocketing up nearly 50% from April lows. And that means big gains for CEO Jensen Huang. As of May 1st, Jensen Huang is the 12th richest person alive, according to the Bloomberg Billionaires Index. Huang has a net worth of over $123 billion, and the majority of which is in his ownership of Nvidia stock. He owns about 860 million shares, according to a filing from early March. Huang recently got his first base salary pay bump in a decade. His base salary as the president and CEO of Nvidia for fiscal 2025 is $1.5 million. That's up 50% from fiscal 2024. Variable cash opportunity or compensation based on certain performance metrics that also increased 50% from last year to $3 million. And Huang's target equity opportunity or compensation through stock options or other equity awards that rose by 25% to $27.5 million, slightly above the median of his peers. Nvidia shares are up 5% year to date, and Huang's net worth has increased by nearly $9.3 billion in 2025. The average 401k savings rate increased to a record high in the first quarter, according to Fidelity. Here with the numbers, we've got Yahoo Finance senior columnist Carrie Hannon. Carrie, what do we know here?
Yeah, hi, Brad. The Fidelity numbers are quite impressive in the sense that people are saving at record high savings rate, as close to the recommended 15% that it's ever been. It's at 14.3% in the first quarter of this year, and about 9.5% of that is the employer match. But this is really encouraging. In addition, they found that about 20% of people actually increased the amount that they put into these accounts. And so by increasing their savings and contributions each year, a very small percentage actually changed their asset allocation. Now, you've got to remember, balances did drop down, but we had a pretty rocky first quarter. It was fairly chaotic. And frankly, I'm a little surprised that there wasn't more asset allocation changing. But let's look behind the numbers. Brad, why this is, in many ways, is that two things. Of the 25,000 employer plans that Fidelity represents, 62% of them are in target date funds. So a target date fund it gives people this, as Mike Shamrow from Fidelity told me this morning, it keeps people from tinkering. They have a little peace of mind when people get crazy, when the markets get crazy, because it automatically adjusts you based on your retirement date allocation. So this is a good thing. And also, it's very important to remember that many employers are now offering auto escalation. And so that means that each year they automatically up the contribution limit from each employee. And so up to 10%, they usually do about 1% a year. So this has really become a big force in the 401k industry, and it's really helps people sock more away for retirement. Even in rocky times, they stay the course, and that's encouraging.
Carrie, while we have you, the Social Security Administration says it processed 91% of cases related to a new law that boosts some Americans' monthly benefits and provides lump sum retroactive payments for nearly 3 million people. Who is affected, and what's happening with the remaining 9% of cases?
That's right, Brad. It's a small percentage they still have to push through, but this is something they started making these retroactive payments and bumping people up their benefit check, some as much as $1,000, which is it could be a tiny amount up to $1,000, and they were done automatically. They say by November they'll have everyone done. The ones that are still lagging behind have to be done manually. So let me remind people what this is. It's for individuals who have worked as teachers, policemen, firemen, that sort of thing. And what it is they have access to the federal government pension, but during their course of their careers, they also worked in jobs where they did pay into Social Security. It could have been summer jobs, side gigs, whatever. So they're entitled to Social Security. And when this law was passed, it started to roll back to say, hey, these folks do deserve to get some of their benefits. So it is happening. It's moving slowly for just some people that need to be done manually, but it does provide a bump for these Social Security checks for those who fell into that category of having both a government pension as well as having paid into Social Security.
Carrie, thanks so much. Appreciate it. Coming up, we explore the benefits and downsides of health savings accounts with the CEO of Health Equity. That's next on Wealth. The average cost of college for public 4-year and in-state and out-of-state undergraduates grew in the 2024-2025 school year from the prior year. And with the Department of Education resuming collections of defaulted federal student loans, it's more important than ever to carefully consider the cost of your education. Bob Powell, host of Yahoo Finance's Decoding Retirement podcast, spoke to Tricia Scarlatta, who is the JP Morgan Asset Management Head of Education Savings, about families needing to have money conversations early on. Let's listen in.
I think you got to be really starting to have that conversation a lot earlier, Bob. I think, we just talked about there's so many options. You don't have to go to the most expensive school. I mean, state schools are a fraction of these private schools. Or, in our College Planning Essentials Guide, one page that we have in there is the community college option. So you could reduce your total cost by almost half if you went to a community college for the first 2 years, and then the last 2 years go to wherever and have that experience. Look, these conversations need to happen really early on because it's very hard for parents, and we know this, to say no, and that's when we get in trouble.
Bob Powell joins me on set now. Bob, these financial talks seem critical. As part of the talks, how can families and college-bound students understand the real cost of college before applying?
Yeah, so the first thing that you might want to do is look at what's called the net price calculator on many of the college websites. And just for example, let's say that a 4-year private school might cost $60,000 all in, and that's just for 1 year, let's say, and that you have a newborn, and that in 18 years, the total cost might be $600,000 to fund 4 years of a private school, which means ultimately that you would need to save about $1,000 a month or $12,000 per year over the course of 18 years to fund $600,000 of private 4-year school.
Wow.
So imagine for a moment that you haven't had this discussion with your child about what will it cost to send you to school, right? You want them to be aware of what it might cost. Now, Tricia mentioned, like, maybe you don't have to go to a 4-year private school. You could go to a public school, and maybe the cost is now, maybe instead of saving $1,000 a month, maybe it's $500.
Right.
Or if you go to 2 years to community college and then to a 2-year private college, maybe you're saving $250 a month instead. So having these conversations early can really help students understand the cost of their education.
Yeah, have a favorite kid too. Maybe that helps things out. Is there a strategy around the types of schools that you should apply to if you're trying to maximize savings?
Yeah, so my strategy, Brad, is to do this. Don't think about it as safety or reach schools. Think about it as funded or unfunded. And so what I like to do is to tell parents, think about sending your kids to colleges where they'll be in the upper quartile of incoming freshmen based on their GPA and based on their standardized test scores. That's where the most merit aid is available. So think about that. Don't think about safety and reach, and think more about, like, what school can I get into that gives me the most merit aid. Use something called Naviance to help you determine that. Most high school students have access to this at their high school, where they can look at where they would fall in terms of incoming freshmen.
Wow, all right, I didn't know that. In terms of actual savings vehicles, 529s are kind of the king option, right?
Yeah, they are. I mean, you have lots of options: taxable accounts, UDMAs, Coverdell accounts. But 529 plans are great because although the money goes in on an after-tax basis, it grows tax-free. And the money coming out is tax-free as long as you use it for tuition, room and board, textbooks, et cetera, et cetera. I would caution those folks, though. Don't just indiscriminately pick the 529 plan from your state. There may be other 529 plans that are better suited for you based on the features that they have and the tax advantage that they may offer.
So what if you or your family are in a bit of trouble because you didn't save enough for your college costs? You might be tempted to dip into other accounts like your retirement savings. There's some risk there, though.
Yeah, I'd say absolutely not. That's an account of last resort, I would say. In part because this, right? You can always borrow to go to college, private and public loans. You can't borrow for your retirement, right? Ultimately. Yeah. So let your children borrow, but don't let them borrow too much, right? You want to think about, like, what their first job out of college will be, what their salary will be, and use that as your benchmark. So if they come out of college and they're going to earn 50 grand, don't borrow more than 50K in loans.
Bob, good to see you. Thanks for joining us on
Brad.
Saturday. Absolutely. Healthcare in the U.S. can be very costly. Americans spent more than $14,000 per capita on healthcare in 2024, according to Health Equity. And the percentage of U.S. adults who were unable to afford or access quality healthcare reached 11%, which is about 29 million people, the highest level since 2021, according to the West Health Gallup Healthcare Indices study. Joining us now, we've got Scott Cutler, who is the CEO of Health Equity. Scott, good to have you here back with us in studio. Tell us about health savings accounts and how they can help bridge that affordability gap.
So first, just understanding what they are. This is an account that is a triple tax advantaged account that you can contribute pre-tax, grow tax-free, and then can spend it tax-free on healthcare related expenditures. It's the fastest growing savings in the U.S. It's grown as a market from 10 to 135 billion in the last 10 years. But today, we have an affordability crisis for healthcare. 40% of Americans cannot afford today a $400 unexpected medical expense. And so you really need to be thinking about how is it that you can be prepared to handle that, plus what you're going to need ultimately in retirement.
And so what are some of the downsides to HSAs as they are structured right now? Because there's this need to expand access as well beyond high deductible plans.
So they are tied to a high deductible plan. So when you're in the open enrollment season, these are provided with through your employer. The first thing is you should be selecting a high deductible health plan associated with an HSA. And one of the big barriers to it is the misconception that a high deductible health plan is more expensive than a low deductible plan. But when you look at premiums as well as deductibles and your out-of-pocket costs are typically about the same. But here, if you choose the right plan or if your employer is incenting the right behavior, you can have a vehicle that can save and grow over time that you can use for those medical costs that you need at any time.
I wonder, as you and your team are looking through what's working its way through Capitol Hill right now in this tax bill, what are the implications, especially on the healthcare sector and through the lens of health equity right now?
This legislation today in its current form has the first expansion of HSA access and flexibility for the last 20 years. And so on the access side, it's improving access for individuals, for example, in retirement that have selected Medicare A and might have a high deductible health plan. They are now eligible to be able to contribute to an HSA. If you are under an ACA plan, bronze or catastrophic, you can now participate. Or if your employer had an on-site medical clinic, you could not participate as an HSA, have an HSA. On the flexibility side, the legislation proposal provides the flexibility to apply HSA funds for gym memberships or to telemedicine. And those provide greater flexibility in terms of where you can spend those dollars that have been put away so sacredly.
We were having our own discussion among our production team earlier this morning in our AM meeting just about the transferability and the rollover in HSAs as they stand right now. What do people need to know about that?
Again, breaking down the misconceptions in the industry, an FSA is a flexible spending account that is a, use it or lose it.
Right.
And so typically a year, if you don't spend it, it goes back to your employer and you lose it. An HSA is portable, it stays with you. So once you've contributed, you'd have it for your lifetime. You should be maxing out your HSA every single year. You might consider maxing out that HSA before a 401k because it has better tax advantages than a 401k, and it's setting you up to be prepared for those costs into the future. So we like to think of it as how can you save, invest, and then ultimately spend for your healthcare needs.
Even as we were talking in the break, I was trying to draw a through line through your various roles that you've held over the course of your career here. And the thing that came up in that Venn diagram, at least for me mentally, was marketplace. How is this marketplace and the health landscape right now vastly different than what you've seen before? And what is Health Equity really trying to position itself to do to really revolutionize that marketplace?
This is the opportunity that got me excited about Health Equity. Coming into a 25-year-old company, it's a leader in its space, and yet healthcare as an industry is very different than the standards that we expect out of a retail experience, which is to say seamless, easy, frictionless. You see price, you can make discovery. Imagine buying something where you didn't know the price. We would not accept that in most other experiences, yet that is the default position in healthcare. And so we believe that there's an opportunity to make healthcare easier, more seamless for our members, and through experiences that we can make available on a mobile phone, a mobile device, to have transparent, educated decisions about where you're spending your health dollars and be engaged in that as a process. That is what I see as the opportunity.
I think there have been a lot of calls for transparency, especially in the healthcare space. Scott, good to have you back on set with us. Thanks so much.
Thanks.
Coming up, everyone, your mid-year credit card check and how to make sure that you're getting the most out of those rewards and points. That's on the other side of this break. According to the New York Fed, Americans' credit balances totaled $1.2 trillion in the first quarter. And as part of our mid-year financial checkup, I want to bring in Clint Henderson, who is the Points Guy managing editor. Clint, good to see you once again. What should consumers be checking in on at this halfway point of the year?
So you want to make sure that you're squeezing every last drop of your statement credits that you get for some of the premium credit cards. You want to check to see if you're in the market for a credit card. So know your credit score, maybe shop around. We've seen some insanely good offers right now in the past couple of months. I know of several off the top of my head where you can get 100,000 points or miles for signing up for a credit card. But right now you want to be checking that you're getting the maximum value from all your cards. Make sure you've set up some automatic payment schedules so you're not missing any payments, because that really dings your credit score. You want to make sure you're paying off the balances every month. And then, like I said, squeeze a lot of cards now have, we call it couponing. So you have to make sure that you're getting all the statement credits that you're eligible for. You can see some of the rules on your screen. You want to not carry balances, avoid foreign transaction fees. A lot of cards have no foreign transaction fees. You want to check to see if you're paying fees for making payments. So increasingly we're seeing like a 2% or 3% charge to use a credit card. That's exorbitant, and you shouldn't be paying that, because then you're erasing any of the benefits you get from having a rewards credit card. But there are cards out there like the Wells Fargo Built card that actually comes, you can pay your rent with that with no transaction fees. Some billing will let you pay without a transaction fee. So make sure you're not getting hit with a transaction fee when you're using your credit cards.
If you're in a good position to sign up for a new card, what should you be looking for?
Look for a giant sign-up bonus. We just saw a huge sign-up bonus from Chase. I have a feeling more coming down the pike. 100,000 points or miles for a low annual fee card is a no-brainer in my mind. I think the American Airlines Executive Card right now has 100,000 American Airlines miles. Some of these cards have really valuable sign-up bonuses. And, I'm kind of the outlier because I have 27 credit cards. But that's how I'm able to travel the world in business class, because I'm signing up for a lot of credit cards, earning those sign-up bonuses, and then downgrading the card after a year if I don't want to pay the annual fee. But you can bet I have a spreadsheet where I track every single card and its benefits and make sure I'm getting all those benefits.
Dozens of cards you've told me you have before here. So once you do get a new card, how do you accumulate those points by the end of the year?
So the main thing is you want to meet the terms of the sign-up bonus. So a lot of the cards, you have to spend a certain amount of money in the first 3 months of card opening. So make sure you're tracking that. I've made that mistake myself, where I signed up for a business credit card and then I spent $998 instead of $1,000, and I did not get the sign-up bonus. So make sure you're getting those sign-up bonuses, and then use the cards that come with bonuses on certain categories of spending. So the Chase Sapphire Preferred Card, for example, gives you extra points on travel, on things like ride shares and taxis. So you want to make sure that you're using the right card. Some people in this hobby go to the length of putting little stickers on their partner's cards to make sure they know what to use, which card for which store, because of the bonus categories. So there's lots of ins and outs. You don't have to get quite that deep into the hobby, but make sure, at least for the main card that you're using, that you know what category bonuses it might have.
Clinton, you're going to have shoppers showing up at stores telling store associates, I'm going to need you to charge me the manufacturer's suggested retail price for that so I can hit this minimum. At the end of the day, how do you know it's time to pull back or even close a credit card?
So if you are paying a huge annual fee and you're not getting the benefits from that, so let me give you an example. The American Express Platinum card comes with all kinds of incredible statement credits, but some people can't be bothered to get those. So it doesn't make sense to pay a $695 annual fee if you're not going to get the benefits from that card. So consider downgrading those cards. Don't cancel them, because that will hurt your credit score. Instead, downgrade to a no annual fee version of the card. So that's one way you really know if you should be closing that card. Also, if you're not able to pay the balance off every month, you don't want to let the credit card companies win the game, because that's how you really start to lose money, is if you're paying interest rates and bounce check fees and things like that. So you want to be really careful with that stuff.
Clint, good to have you back on the program with us. Appreciate you taking the time once again.
Anytime.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes your way, 3 p.m. Eastern Time. You don't want to miss it.